Let's say the eligible bill is $10,000.
Okay.
So for this $10,000, before you can claim, you need to pay the first layer of which is called the deductibles. So deductibles can be as high as $3,500.
Okay.
So of this imagine $10,000 bill, right? You can't pay this. You have to pay this $3,500. Beyond this $3,500, which is 10,000 minus $3,500, $6,500. Beyond this $6,500, you need to also pay 10% of this $6,500. So it's $650. So what it means is this: for a $10,000 bill, you have to pay $4,150. If you say that, well, you don't want to pay so much. You don't pay the $4,150. Can you do something about it? Yes, you can.
Welcome to another episode of 10 Must Know Insurance Tips Agent May Not Tell You. I'm Jayla, Experience Specialist, and this is Eddy, Haven CEO and our favorite insurance expert. At Haven, we believe that insurance advice should be clear, not confusing, and always aligned with your needs. I'll ask the question that you have always wanted to ask, and Eddy will answer them with no jargon and no fluff. As a layman myself, I promise I'll keep asking the question until I get it. So let's dive into today's topic. So Eddy, today we will be talking about integrated shield plan premium actually skyrocketing, and there's a lot of people wondering, should we consider downgrading our rider? So the first question I do have for you is that my shield plan premium has increased by 30% for my age group, and I've noticed that it's going up every year. Do you know why this is happening?
Actually, this is very concerning. Actually, after recently I also checked with my IP premiums. My IP premium cash portion has increased from 2003 to 2001. And actually, that's 60% increase. It's very scary to receive your renewal letters and then wondering whether how can you finance this in the future, right? So there are a few reasons why IP premiums increases. There are two big reasons. Firstly, medical inflation. The cost of advancements in medical science and the salaries of medical professionals has gone up, and therefore it accounts for that. But more seriously, it's actually the claims rate. Because of the way how the current IP plans is being designed, is very generous. It's creating this buffet syndrome whereby there's over-treating, over consumption, and overcharging. And all this actually, what it means is that it actually increases the premiums, the claims to the insurance company. At the same time, the insurance company also not making a lot of money. In fact, some of the IP providers are actually losing money, and therefore they have to transfer these claims back to the consumers, which is the policyholders, and this results in all these changes. I think it's scary because every time when we receive IP letters renewal, right, we keep asking two questions: where do we need it? Can we afford it? So it's very important to really understand what is our reason for getting just IP plans.
I see. It's also like you never know what is the amount going to be until you open the letter.
It's always a question mark.
Like surprise, you know?
But by the design of the IP plan, usually as we go older, it should increase. It should. But because of all this inflation, as well as the claims rate, right? There is this unknown. We don't know how much it will increase further.
So it's quite scary lah. So right now, I have a IP plan with a rider for myself lah. Since the rider is so expensive, right? Can I drop it? Because I'm wondering, is it really worth it?
So that's a very good question. Typically, the IP plans have two components. So the first component, we call it the main plan. And then there's a rider, which is the optional plan. So the main plan basically allows you with sufficient benefits to go to the ward of your choice. So for example, if your choice is to stay in a government hospital A ward, then you buy the main plan, IP main plan, that correspond to that. So when you do that, most of the costs can be taken care of, especially the big bills. Right? So what happens if you have a public hospital plans and you go private? When you go more than your plans, that's where your claims will be very much reduced. There's a discount on what you can claim. So it's always important to make sure that your IP plan matches your healthcare expectations.
I see.
Otherwise, you end up a lot. So the IP plans actually, the main plan basically covers all your eligible bills, but it doesn't cover two things. It doesn't cover deductible and co-insurance.
Okay.
So let's give a simple example.
Okay.
Let's say the eligible bill is $10,000.
Okay.
So for this $10, before you can claim, you need to pay a first layer, which is called the deductibles. So deductibles can be as high as $3,500.
Okay.
So of this imagine $10,000 bill, right? You can't pay this. You have to pay this $3,500.
Yourself.
Beyond this $3,500, which is 10,000 minus $3,500, $6,500. Beyond this $6,500, you need to also pay 10% of this $6,500.
Okay.
So it's $650.
So
what it means is this: for $10,000 bill, you have to pay $4,150. Okay, and then the rest of the 5,000 plus you can claim.
Okay.
So this is typically how the IP plan is being designed. Okay, you have to pay a portion, and then the rest you can claim from the insurance company. But what if you say that, well, you don't want to pay so much, you don't pay the $4,150. Can you do something about it? Yes, you can. You buy a rider. So when you buy a rider, depending on, there are a few variants, different types of rider. But basically, you buy the rider. If you buy the most premium riders, okay, what it does is that it can waive the deductible.
Oh.
That means you don't have to pay the $2,500. You can even claim the $2,500. And then of the $10,000 bill, you only need to pay 5%, which is $500. So instead of having to pay $4,150 with a very big rider, you really need to pay $500. So you save about
$3,000 plus.
$3,000 plus. Okay, so the rider helps to reduce your out-of-pocket expenses.
Okay.
So I'm not doing a $10,000 example, but if today the bill is $100,000, very typical of going if a person goes for long treatment or even in private hospital. So the savings will be a lot using the rider. But rider costs money. Costs money. So you need to really see whether you can afford it. You willing to, whether you want to absorb this payment, the out-of-pocket expenses, or you buy a rider.
I see.
However, having said that, there are some recent developments in IP cancer coverage. Okay, so in the past, cancer coverage can be covered typically in full, hospitalization. Okay, however, in recent years, because of the industry trying to control the claims, they actually reduce the cancer cover. So for cancer drugs, they are outside the list, cancer drug list, it cannot be claimed. So what happened is that the rider now actually do provide some form of cancer claims, extra coverage for cancer claims. So some people will buy the rider for not just to reduce our pocket expenses, but also for extra cancer claim. Okay. Of course, having a rider is expensive. But as a general rule, if you are having a private hospital plan, it might be prudent to have a rider.
So you pay lesser out.
Because the cancer treatment in private hospital can be very expensive. So the rider does provide that.
Understand. Okay, so Eddy, just now you mentioned about that there's actually different kind of rider. So let's say right now I choose to downgrade my rider. What does it actually mean to my plan, and how it will affect me?
Okay, first of all, it's important to see whether does the IP insurer provides different riders, different IP riders, because not every insurance company have different variants. There's some only have one type. Okay, but if you have a few choices IP riders, you can actually decide which one will make more sense to you. But typically, every IP providers have structured their rider differently. So for the very expensive one, the premium one, you could actually waive away the deductible, the $3,500, and also reduce the co-payment to maybe 5%. Okay. So that is the most extreme. Or it could be a smaller rider whereby it doesn't waive the deductibles, or it doesn't waive the co-insurance, or it doesn't waive the deductibles. So there are various different there are different types to suit different needs based on the budget. Okay. So you have to weigh the options. What is suitable for you? But definitely, when you go for a lower one, you can actually save your renal premiums. Another thing to take note is that when you downgrade your IP riders, in terms of underwriting, there's no need for medical checkup. It's just administrative. You just tell the insurance company you downgrade, and that's it. There's no need to go for medical checkup. There's no need to see whether has your health deteriorated from the time we bought the plans. There won't be new exclusion being imposed on this downgrade. So it's actually very seamless, and it's very straightforward.
Easy. I see. So you mentioned about no underwriting. So let's say if I downgrade already, and then next year I want to upgrade, can I do that, or how will it affect me?
IP plans, like all insurance plans, has underwriting criteria, especially when you increase your coverage. Because from the insurance company standpoint, when a person buy more, there is a higher risk to insurance company, and therefore they need to make sure that the person is eligible. So when you downgrade, and then when you downgrade, there's no need underwriting. But when you upgrade again, they'll look at underwriting again. They look into your health conditions, whether you qualify. If there's any medical conditions that happens over the last 12 months, the insurance company will be very concerned, and then they may, for example, if it's very serious, they may decline, or they may increase the premiums, or they could just exclude that condition.
But when they decline the upgrade, right? They don't decline my current plan, right? So I'll still have my current plan, right?
You're very well informed.
Right.
Yes. So when they decline, you can still fall back to your original. That is provided you are sticking with the same insurance company. So if you move from one company to another company,
then you lost.
Then you drop and then buy another company. Then yes, you don't have
any.
You cannot fall back. You cannot fall back. So always do it within the insurance company.
I see. Noted on that. Okay. So are there any ways that I can do or to actually avoid the rising of the premium for my integrated shield plan?
And still keeping your original IP, right? Plans?
Any alternative is there?
Well, if you want to keep your IP and then want to cope with the rising premiums, I think there are only two ways to go about it. Firstly, you need to plan for it. You need to anticipate the rising premiums and then set aside money to afford it in the future. That is by far the best way, the long-term way of doing things. Second way is it depends on the insurance company. Because some insurance company IP plans, they offer what you call no claim discount, as well as claim-based pricing. So no claim discount basically means this. But before I continue, not every insurance company offers that. So you have to check whether does a company provides that. So if it's offering no claim discount, what it means is that if there's no claim in the previous years, then you are entitled to enjoy a certain discount, maybe 5-10% discount of your premiums. So as long as you're healthy, as long as you don't make any claims, you get discount.
They give you automatically, or you need to apply?
They net off.
Oh, they net off for you.
So that's good, right? But the moment you make a claim, right, that discount will be gone. Then after that, you revert again when there's
can
no
restart
more claim.
Can restart? Okay.
So the second approach. Some certain IP plans practice is basically claims-based pricing. So claim-based pricing basically means that, well, it depends on claims. If today there's no claims, they'll give you maybe a very significant discount. Maybe 20% or things like that. Depends on insurance company. But if there is a claim, and if the claim is huge, then they will impose extra premiums. So this may not be so good for people who is very concerned that if they claim, they pay much more. So there are two ways. But the point is that if for this kind of plans, if you able to avoid or don't have to claim, right, you can actually enjoy some discount. But these are just very short term, I think.
Okay.
Because the fact is that the base plan of the premiums will keep increasing at a very fast rate.
And one day you have to claim. I feel like you can't be healthy forever.
Yeah, that's right.
Okay, understand. So we do have one last question from the audience. So it quote that I'm 60 years old, retired, and without an income. How can I continue to afford my premium for the integrated shield plan?
So you mentioned about retirement. For retirees, there are a few concerns. It's regarding finances. So for retirees, they want to have firstly a stream of income to provide for living expenses. That's very important, right? Because we no longer have our income. And second thing is to have a good safety net against medical events. Right. So when it comes to safety net for medical events, we are talking about actually two types of plans. Firstly, hospitalization. Because as we grow older, the chances of being hospitalized, needing treatment increase. And second thing is long-term care. Long-term care, caregiving services. This is where your Cashier Life, Elder Shield comes in. Okay, because as we grow older, there's a higher chance of disability. In fact, 1 in 2 age 65 will suffer some form of long-term care based on national statistics. So having these two things is very important. Besides having adequate medical safety net, what is more important would be the funding part, the premiums part. Okay, because you need to fund the premiums to have the insurance coverage, right? So one of the observations is that many people use the CPF MEA to pay for some of the premiums. Okay, but according to projections, because of the rising cost of insurance, right? Some people at the age of 80 or so, their MediSave account may have run out. Okay, so what this means is that you, as retirees, you may need to top up into your MA for you to continue
to pay for
premiums, right? So this is something that retirees will observe. First, making sure that you have sufficient safety net and also the resources to pay for it. So at Haven, we have these retirement services. We call it the CORE service. CORE stands for CPF Optimized Retirement Essentials. So it's basically to give retirees a certainty of their retirement cash flow so that they can retire with peace of mind. For these core services, we look into 3 essential aspects. We call it the 3 C's. The first C is CPF management. CPF offers the highest risk-free interest rates. So if you know how to optimize this well, you can actually do a lot of significant benefits to your retirement planning. The second is your cash flow management. So in cash flow management, we talk about creating a safe and reliable stream of income for retirees to pay for their living expenses, essential expenses. Okay, because having this stream of income is very important because having a strong, reliable income will give you peace of mind in your retirement years. And thirdly is medical safety net. The C stands for coverage. So because as we grow older, there'll be higher probability of needing treatment or disability. Having this will make sure that our retirement funds will not be depleted because of these unexpected medical events. Okay, so the whole idea of these core services is to create a plan that gives a highest probability of success for retirees to go through retirement with a peace of mind.
I see. Okay, so I believe for our audience who are interested in this core assessment, they can head to our website at haven.com to send an inquiry form and our team will reach out to them. So thank you so much, Eddy. If you guys do have any questions, you can ask us down in the comment section below, and don't forget to give us a thumbs up and turn on the bell button so you will always receive a notification when we post a video. See you next time. Bye bye.
Bye bye.
Today very smooth.
Is it?
Yeah, very natural. I feel very natural. So you mentioned earlier about downgrading the rider if you know.
No, I didn't say.
Premium one and whatsoever. Sorry.
Today very smooth.
One of the what? I'll repeat. Go back to Haven. So at Haven we have this return that will give you because of the buffet syndrome, wow, not very smooth.
Today very smooth.
If you do have any questions or anything, please drop. Today is not
Like, share,
smooth.
subscribe.
Today is not smooth. Okay.
Feel very natural.